Good afternoon and welcome to today's presentation, Reading Financial Statements for Lawyers, Part 1. Our presenter is having some technical difficulties today, so just bear with us. The information presented by the expert is not to be used as legal advice and does not indicate a working relationship with the expert. All materials obtained from this presentation are merely for educational purposes and should not be used in a court of law, sans the expert's consent, i.e. a business relationship where she or he is hired for your particular case. In today's webinar, Mr. O'Neill will discuss accounting equation, liability and equity, GAAP, general accepted accounting principles, significant principles, accounting methods, levels of assurance, balance sheets, asset categories, and liabilities and retained earnings. To give you a little background about our presenter, Mr. P. Dermot O'Neill is a CPA with more than 40 years of public accounting experience with a BS in economics from Villanova University. P. Dermot's practice concentrates in areas of forensic accounting, litigation, support, business valuation, transaction consulting, financial analysis, and income taxation. He has provided consulting and expert witness assistance in cases involving oppressed shareholders, personal injury, wrongful death, accounting malpractice, contract, and tort issues. P. Dermot is the managing editor of the National Litigation Consultants Review, in which he has written numerous articles. He has testified as an expert in many states, as well as the Federal Bankruptcy Court and Federal District Court. P. Dermot has presented continuing professional education seminars sponsored by various state accounting institutes and societies, bar associations, and universities. Attendees who require a passcode, the word for today is statement. In the Q&A session, we ask that you enter this passcode into the Q&A widget for CLE reporting purposes. The Q&A is located to the left of your screen. Please remember that if you are applying for CLE credit, you must log onto your computer as yourself and stay for the full 60 minutes. You are also required to complete the survey at the end of the program. Please note that CLE credit cannot be given to those watching together on a single computer. Tomorrow morning, we will send out an email with a link to the archived recording of the webinar. The slides can be downloaded from the resource list at the widget at the bottom of your screen. Thank you all for attending today, and Dermot, the presentation is now turned over to you.
Okay, I'm going to need your assistance because Comcast is still not having a good day, so if you can advance the slides when I ask you to, that would be greatly appreciated. Does that work for you?
Yes, that works, Dermot.
Okay, great. So we should be at the opening slide, which says Reading Financial Statements for Lawyers. I'd like to just give you a very brief background about in 2005, I was testifying in Lycoming County on a business valuation in an oppressed shareholder case, and the judge was from out of the county because the case was very politically sensitive, so they brought the judge in from a neighboring county. He was basically a criminal judge, and this was his first commercial trial. At the end of my testimony, the judge asked, he said, "Mr. O'Neill, is business valuation science or art?" And I said, "Well, Your Honor, the formulas are science, but the input into the formulas is art." So he said, "Well, the whole thing then is an art." And I said, "That's pretty much it, Your Honor." And that's pretty much what we have with financial statements. The financial statements, although they look like they're absolutes, many of the numbers, perhaps with the exception of cash, are really a function of the different concepts that are used to derive the numbers. And in the program today, we're going to specialize, or not specialize, but look specifically at medium and closely held business as opposed to publicly traded companies. However, where it's appropriate, I will throw in some comments relative to publicly traded companies if it's appropriate. And also, as you're aware, many times in litigation and other situations, we're presented with tax returns instead of financial statements. So where it's appropriate, I will make some comments in in that area to note the differences and similarities. Could you advance the slides, please? The next slide is the basic accounting equation, as we call it, ALE, assets equal liabilities plus equity. This is the equation that was developed by Luca Pacioli in 1495 approximately, when he wrote his book. I believe it was called Mathematica or something like that. But this equation was developed by him, as well as terms that we know today: ledgers, journals, debits, credits. All those were developed by Father Pacioli, and we rely on those concepts and those theories today. Next slide, please. The next one we're going to talk about is the terms. We said assets equal liabilities plus equity. From an accounting standpoint, as opposed to a legal standpoint, what is an asset? And quite simply, an asset is something that's tangible or intangible of value that is owned by the entity, and it can be recorded on the books of the company. The concept of being recorded on the books of the company is particularly important because from an accounting standpoint, something can be recorded when it can be measured. So our cost principle says that a transaction can only be recorded as its cost or measured by what was given up. So in order to record something on the books, regardless of what it is, an accounts receivable, an expense, a piece of equipment, or whatever, we have to be able to measure it. If we can't measure it from an accounting standpoint, it's not going to be recorded on the books. This is beginning to change about 5 or 6 years ago when we came out with this concept of fair value accounting. Fair value accounting is applicable in acquisition situations. And basically what we're required to do is to take a look at the acquisition price, allocate the price between tangible assets that can be valued, intangible assets that can be valued, patents, trademarks, copyright, workforce in place, customer lists, et cetera, and the balance goes into goodwill. This is required of publicly traded companies in a transaction methodology, but it's not as strictly required with closely held companies. So what this leaves is a situation where a company may in fact have self-created assets, which we'll talk about in a couple of minutes, but there's no value because there is no cost to developing those assets. However, in a transaction or a potential transaction situation, they may in fact have value. Next slide, please. So we have the example of a family business that's been in the same location for 50 years. Business has an excellent reputation for customer services and continues to grow and prosper. Well, clearly, that has value. In fact, it's been in business, it's got an excellent reputation, and so forth. So the company does have what we generally call goodwill. But since there was no cost associated with that goodwill, it's not on the books of the company. So that even though goodwill may exist, because it couldn't be recorded at cost, or there was no cost to record, perhaps more appropriately, you're not going to find it on the books. However, we'll see one of the cases a little bit later where there was a transaction where, in a bankruptcy situation, where those intangible assets were considered. I'm going to advance to the next slide. The next thing in the equation, we have assets equals liabilities plus equity. What's a liability? It's kind of the converse of an asset. It's something of value, again, generally measured in money or services, owed that can be measured in terms of money. So we can measure future services in terms of money today. So some of the examples, the common examples are a publisher. A publisher receives money typically in advance for an annual subscription, and the publisher has a liability. The publisher owes a liability of service and delivery of the subscription. So at any point in time, that 12-month subscription, part of it has been earned and part of it is a liability. In other words, they still have to do something into the future. Another example is an automobile dealer that sells an extended warranty. And until that warranty expires, which might be 3 years out, the dealer owes the customer the specific services that are covered in the warranty. All of these can be measured in terms of money. They may not be precise, but they certainly can be reasonably estimated. For example, take the situation with the warranty. And I've had discussions with folks like this. They believe that the liability, as the car gets older, the liability exposure actually tends to increase because the manufacturer's warranty covers the early days, and the dealer warranty covers the later days, which is when their most exposure is. So some people would say, well, we'll take that premium and just amortize it straight line over the life of the asset. Some other folks said, well, we should really consider earning very little premium here, but earning a lot of the premium towards the end when we'll be doing the work. These are the conceptual issues that we run into. Advance the slide. The next part is the equity. Assets equal liabilities plus equity. Equity as a concept, some people believe that it's a residual claim by the owner. Some people think about that. For example, a liability is a claim against the assets of the business by a creditor. One of the concepts says that equity is a residual claim by the owners of the company against the assets of the business. The interesting point about that is that, in fact, there really is no claim. No owner of a business has a right, as an individual right, to any of the assets. But from a conceptual standpoint, some people like to think of it as a claim against the assets, although they had no right, particularly if they're talking common shareholders, have no right to a proportionate share of those assets. Now, equity is, as you see in the slide, the residual value would be dictated by the assets minus the liabilities equal equities, which is a simple algebraic expression. Now, the components of equity can actually be calculated. Equity, owner's equity in a company is increased by owner's investments. So if you buy stock in the company, or if you put in additional capital, the equity of the company is going to increase. The equity of the company will decrease when that particular company pays dividends or they pay distributions. So that's going to decrease equity. Equity is increased by revenue. When the company sells a product or service, that's revenue. That increases the owner's equity in the business. Conversely, when the company pays expenses, that decreases the owner's equity in the business. Those two elements, revenue and expenses, are shown, the net is shown in the income statement, which we'll see on Thursday. So that the main components of equity are investments into the business by the owners vis-a-vis capital stock or additional paid-in capital, or decreases by distributions or dividends, and its net increase or decrease by profits or losses in the income statement. Next slide, please. The next slide talks about the famous words, generally accepted accounting principles, or GAAP as we commonly refer to it. Now, GAAP presents the principles and concepts behind the recording, interpreting, and reporting of financial transactions. The recording we typically call bookkeeping, which is just simply recording transactions. Accounting we typically refer to as interpreting. In other words, what does this transaction really mean? What was impacted by this transaction, and so forth. And finally, reporting, the recording, and interpreting is financial statements, which is the subject of the program that we're talking about today. The old definition of accounting used to be the art and science of recording and interpreting financial transactions, which pretty much holds true today. It's the bookkeeping is the recording, the interpreting is the accounting, and reporting is the financial statements of all those transactions. Next slide, please. We talked about Brother Pacioli or Father Pacioli, I'm not sure what his correct title was. And he started this back in the 1495 or thereabouts. In the late 19th and early 20th century, accounting began to take on a professional look. And a profession was established, and they started licensing CPAs. And back in the early part of the last century, virtually all the big four CPA firms were established, and many of them they all continue today. Once states started issuing, and states still issue a CPA certificate. It's not a national certificate; it's a state certificate. The American Institute of Certified Public Accountants was established, and from the early 20th century until approximately 1976, the American Institute of CPAs was the primary body of authority in establishing and interpreting generally accepted accounting principles. So we had this group, the AICPA, which still exists down in the Carolinas now instead of New York, but they established what generally accepted accounting principles were. And back in those days, it was pretty much like a democracy. CPAs all over the country would meet, and they'd gather, talk about how they handle certain transactions, and a similarity of handling transactions became apparent, so that became a principle, generally accepted accounting principle. And then it was up to the American Institute of Certified Public Accountants to kind of interpret those principles for general application. So prior to the 60s, generally accepted accounting principles was concept-based. In other words, you would put out a concept of, and we called them back in the 30s and 40s, concept statements. You put up a concept statement of what revenue is, and then it was up to the professional CPA in his practice to employ or to determine what was revenue and what wasn't revenue. So you were pretty much held up responsible for your own decisions as to what was appropriate and what was not appropriate. Then along came the early 60s, and we had two significant things that happened. One was Accounting Principles Board Opinion number 2, which related to the investment tax credit that was passed around 1962. When the boards, the Accounting Principles Board of the ICPA went back and forth between how you treat the investment tax credit. The investment tax credit, for those of you who may not have been around then, basically was a credit against your income tax that you got for buying a piece of equipment. However, if you sold that piece of equipment beyond or before the life was expired, which I believe is 5 years at that particular point in time, then you had to pay that credit back. So the issue then became, what is this? What is this credit? Is this a liability because I might have to pay it back? Is it a reduction in my income tax expense? Is it a reduction in what it cost me for this particular piece of equipment? And this went back and forth and back and forth. Then in about 1963 or so, we had the 1136 tenants case in New York. And basically the court ruled in the tenants case that if your work was being done by a CPA, you had a right to believe that you were being audited unless the CPA told you that you were not being audited. So that this threw the fear of God into many CPAs. In other words, the Accounting Principles Board started vacillating as to how certain items should be treated. The New York courts were saying that if you're a CPA, you're deemed to be auditing a company unless you say otherwise. So the profession turned to the American Institute of CPA to say, please, oh great CPA, AICPA, give us rules. We can't deal with this principle stuff. We need rules. So the AICPA then took it upon themselves to start setting up rules that were generally accepted accounting principles. And that's what we call basically self-regulation, as typically self-regulation is a failure. Back in 1976, for example, I was at a meeting. We had meetings in, I think, 40 cities throughout the country. And the issue was, shouldn't there be different accounting principles for big publicly traded companies and smaller closely held companies? And we argued back and forth and back and forth. And the only thing that came out of those meetings in 1976 were the fact that smaller companies shouldn't have to report earnings per share, which is public companies do have to report earnings per share. And finally, the financial community got fed up with this, and they set up the Financial Accounting Standards Board, which is now responsible for establishing generally accepted accounting principles, and it is a rule-based process at this particular point in time. Let me go to the next slide, please. The next few slides are going to talk about significant items in the mindset of the CPA. And the first one is conservatism, and conservatism, obviously we as a profession have been known to be very conservative for many, many centuries. But conservatism principle says that as an accountant you need to provide for all losses and anticipate no gains. Provide for all losses and anticipate no gains. So we have inventory as an example, which is recorded at cost. However, at the balance sheet date, the market value, if the market value is less than cost, inventory may be adjusted down to market value. And that principle is the lower of cost or market, providing for all losses and anticipating no gains. And we'll talk about inventory in a little bit more detail a little bit later. Then we have accounts receivable, for example. We reduce our accounts receivable for expected non-collectible accounts. This is true for generally accepted accounting principles, but is not necessarily true for tax return purposes. On our tax return balance sheets, you'll find those on page 4 of any of the business tax return. It's page 4, Schedule L. On Schedule L, page 4, you're supposed to put in the financial statement balance sheet as it would be on the books and records of the company and not the tax return balance sheet. However, that's not always religiously followed by many CPAs. But an example of a difference is accounts receivable, where for generally accepted accounting principle purposes, you'd reduce your accounts receivable for expected bad debts or uncollected accounts. For tax purposes, that's not a permitted methodology. For tax purposes, you need to wait until you actually determine that an account is collectible before you take the expense and reduce the accounts receivable. Other significant items we talk about are accounting methods. Can you advance the slide, please? Sorry. The accounting methods are the primarily one is the accrual method, and that's basically defined where revenue is recorded when it's earned and expenses when incurred. Accrual method is basically the bottom line generally accepted accounting principles. If you're using the accrual method, that is generally accepted accounting principles. The second method is cash method. And cash method is defined as revenue is recorded when received and expenses when paid. This is a generally accepted accounting principle in certain areas. For example, nonprofit organizations will generally use the cash method. Some municipalities and governments may use the cash method. But conceptually, the cash method is when revenue is recorded when received and expenses when paid. For certain industries, cash method is appropriate for tax reporting purposes. So consequently, if you don't have financial statements, but you're in litigation or have some other issues, and you get a tax returns on the cash method, it's really not all that helpful because you don't have all the information that you would have on the accrual method. Another method which is acceptable is a long-term contracts method. And under that method, we have two sub-methods. One is called the completed contracts, and the other is called the percentage of completion. Typically, you'll find these in construction projects, shipbuilding projects, and so forth. Unless you're involved in that area, you're really not going to run into it. But the completed contracts approach basically says that revenue and costs are recognized at the end of the contract. During the period of the contract, the revenues expended and the expenses and the revenues are shown on the balance sheet as assets or liabilities, as the case may be. The other long-term contract method is the most common, which is the percentage of completion, where you recognize a portion of the revenue, a portion of the profit during the construction period. So that if these are all properly implemented, these are all considered generally accepted accounting principles. So you can begin to see the importance of if somebody gives you a financial statement, it's important to know what method they're on, what what principles they're operating under, and so forth, because not all financial statements are the same thing. Now, in closely held companies, which are non-public, we have what we call OCBOA, or Other Comprehensive Basis of Accounting. This is not generally accepted accounting principles. OCBOA basically have two primary methods. One is the tax accounting method, where you're preparing a financial statement that shows exactly the way things show on the tax return. And you're not doing a generally accepted accounting principles financial statement. It's an OCBOA financial statement. And finally, we have hybrid methods, which are a jumble of both of all of these methods. So, for example, it's quite common to have a cash basis financial statement, but have unearned wages shown as a liability, even though it's not appropriate under the cash method, or retirement plan contributions which have yet to be made, even though this is the cash basis and they haven't been paid yet. So the slide indicates that their selection of methods significantly impacts the financial statements, and one of the first questions you want to ask is what methods of accounting are being used. The next slide, please. This should be reading levels of assurance. I hope we're in the same place. When a CPA prepares a financial statement, there are certain levels of assurance that are given. The highest level of assurance is an audit, where the CPA says the financial statement is presented fairly in all material respects and in conformity with general accepted accounting principles. It's an affirmative statement. Of course, as attorneys, you know the word fairly and the word material can be subject to discussion. So, and this is one common misconception. People see that, oh, I see an audit. It's an audit report. They did an audit. It doesn't mean those numbers are accurate. It means those numbers are fair. And it means those numbers are fair in all material respects. There may be some small things that are not particularly appropriate. Of course, the question comes in, what's material? Well, that's really up to the auditor. And so one of the questions I always ask when these are involved in litigation is what the auditor's criteria for materiality is. The second is what we call negative assurance, is a reviewed financial statement where the accountant says, I'm unaware of any adjustments that need to be made to make these financial statements in conformity with generally accepted accounting principles. Here's the numbers. I did a little bit of sniffing around, and I'm not aware of any adjustments that need to be made to make these in accordance with generally accepted accounting principles. Then we have the compilation, which gives no assurance. It just says, I prepared this from the books and records of the company. The audit and the review, the accountant needs to be independent of the company. In a compilation, the accountant doesn't need to be independent as long as the lack of independence is disclosed. So those are the three primary levels of assurance that we have. Now, recently, the AICPA came out with this level of service called a financial statement. And that level of service basically is when a CPA is produced, a financial statement, it could be just went in and pushed the buttons on QuickBooks, is produced when a CPA is not engaged for an audit, review, or compilation. There's no assurance and doesn't need to consider independence, and there's no report. Now, in the concept of report, a report is the accountant's letter. It says, I did an audit, I did a review, I did a compilation. Those are what we consider to be the accountant's report. And the final kind of financial statement you'll get is what's internally prepared by the client, by the business. And as my comment says, good luck with that. That can be almost anything. Just because it says balance sheet on top of the QuickBooks presentation doesn't mean it's a balance sheet for generally accepted accounting purposes. How do we handle the questions? Do I answer the question? Is that how it works?
Sure, yes. Now we are entering the Q&A session. During this time, please enter the passcode in the Q&A widget. The passcode is statements. Also, please enter the questions you have for Dermot. Please remember that if you are applying for CLE credit, you must attend for the full 60 minutes of the presentation. First question we have is in a business valuation with only 2 shareholders and 1 shareholder agrees to buy the other shares for fair market, the value, and they agree to an accountant, is it correct for the accountant to value the business using cash, fixed assets, and accounts receivables, less accounts payables? Does it make a difference if the person buying the other shareholder's shares is the rainmaker?
It makes a difference. What you're describing is what we call the asset approach. The asset approach on a business valuation is simply a listing of the assets at their fair market value, not their book value, but the fair market value. What we've been talking about so far is book value. And the other thing that's important is what standard of value you're looking at. Transactions between shareholders are generally done at fair market value or fair value. For example, in New Jersey, if there was any kind of dispute, the standard of value would be fair value, and we'll talk about that very briefly. Fair market value basically considers discounts for lack of marketability and lack of control. In a 50-50 situation, there is really no controlling interest. You have 2 what we call non-controlling interests. So what happens frequently in those cases, and I've had this situation where theoretically in a valuation exercise, what is being given up is what's valued, but many times the shareholder that's giving up says, well, I want it valued at what my partner is getting, which is going to be a higher value than what the individual is giving up. So the question is geared towards methodology, and certainly if the fair market value of the assets minus the fair market value of liabilities, that's one approach, but there's also the income approach and the market approach, which is applicable to closely held companies. Go ahead.
Next question. Is that okay?
Yep.
If one person kicks another person out of the business, how is the business valued to determine its value?
Basically, when I do evaluation, for example, I use all 3 approaches where I can. I use the asset approach, the income approach, and the market approach. They will all come up with different values, and I will usually reconcile the particular value. Now, somebody's getting kicked out. I'm assuming we're talking about oppressed shareholders. The oppressed shareholder statutes in each case, in each state, are different. As I indicated before, in Jersey, for example, under the Balsamides case, in the, I guess it was the late 90s, the standard of value was fair value, which indicates that the person that's getting kicked out should get his pro rata share of the entire company, value of the entire company. Fair market value, standard of value, is basically where the individual's interest that's being purchased is valued as if it was on a market, and there would be discounts for lack of marketability and lack of control. The tricky thing about state statutes are many times the state statutes will say we're valuing it at fair value, but then when it's defined as in the state statute, it really is a fair market value definition. So it depends on your state statutes. All 3 methodologies should be considered. I know when we do evaluations for litigation, we stipulate that we did consider appropriate methods and use them or not use them and why. And that's really the best way to approach that.
Is there a special expertise other than CPA to calculate damage to business valuation as a result of breach of contract?
Absolutely. Yeah, that's one of the seminars I teach nationally. It's a deep dive into lost profits and so forth. Yeah, see, the typical and the differential that I make is one of analytics. The typical CPA is not trained in analytics. My education, fortunately, went way beyond that, and I do quite a bit of analytical work. The other thing is that, and this is kind of related to business interruption losses and so forth, is that that's not a lost profit situation. But in my opinion, it takes a bit more training to look at the lost profits, because you've got different processes. You've got projection method. You've got the but-for approach, it's a but-for approach, and but for the acts of the defendant, this is what my profits would have been. It could be a before and after methodology, a projection methodology, a market methodology. So there's all these methodologies that most traditional CPAs are not familiar with.
The last question we have for now is, can a company have assets that are not on the balance sheet?
Absolutely. The assets may exist, but the assets may not be valued for accounting purposes. This would be the typical intangible assets, the trademark, not the trademark, but the workforce in place, for example. It's valuable to have a workforce that's trained and in place, but this is not valued for accounting purposes. And we'll see in a case a little bit later on where there is value for transaction purposes. Okay?
Thank you for answering those questions. You can continue on with your presentation.
Okay, the question in the presentation is, which of the following is not a method of accounting? And that's answer C, which is a fair value method. The accounting methods we talked about are cash accrual and long-term contracts method. Now, the next slide relates to the balance sheet. The balance sheet is a statement of book value of all the assets and liabilities. Notice the book value. It's not market value. Book value is a concept of accounting. It's an accounting concept. It has nothing to do with market value. Of all the liabilities, including equity of a business or other organization as of a particular date. So the key thing is the balance sheet is as of a date. It's like a snapshot, as opposed to the income statement or statement of cash flow, which we'll see on Thursday. It's at a particular date. Now, some of the categories, the major categories of assets are current assets, and those are items which will be converted into cash, expected to be converted into cash within the next accounting period, which is typically 1 year, sometime in longer term contracts, like construction contracts or shipbuilding contracts and so forth. The accounting cycle might be more than 12 months. But in the typical case, we're looking at 12 months. So the current asset is an asset that exists that will be converted into cash within 12 months. The typical cycle is you have inventory, you sell the inventory on time, the inventory becomes an accounts receivable, you wait your 30 or 60 days to collect your accounts receivable, and the money comes in and it becomes cash. So that's your typical cycle. So a current asset is something that would be turned into cash within the current operating cycle. Now, some of the types of current assets, we have cash, which is pretty obvious. It's liquid. We have short-term investments. These are securities, certificates of deposits, and so forth, which we intend to consume in our operations or sell sometime within the next 12 months. Accounts receivable are typically realized within 12 months. Hopefully they're realized within 30 or 60 days, but normally within at least 12 months. Inventory, these are assets that are going to be traded in the normal course of business for accounts receivable and then flipped into cash whenever the accounts receivable are collected. Now, the inventory valuation is really important on your balance sheet. I testified on Friday in federal district court in Philadelphia as to whether or not the inventory was at fair value, which is the requirement in bankruptcy for insolvency. Now, how do you, the very general concept is that inventory is at cost, but how do you determine cost? The illustration, we have several. We have kind of average cost, the cost what you paid for it, etc. But there's also different valuation methods. Let's take the best example is corn in a silo. You go buy 10,000 pounds of corn, you dump it in the top of the silo. You go out and you buy another 10,000 pounds of corn, you dump it into the silo. Well, the price per pound is going to be different. So your inventory cost is going to be different as it develops. Now, let's take a look at your silo. When you sell that corn, do you take it out the top, which is the last in, first out method, or do you take it out the bottom, which is the first in, first out method? So with fungible type goods, your costing can be extremely important in what's your book value of the inventory. For example, the case that I was involved with last week, they were dealing with precious metals. And during the time period at issue, one of the precious metals dropped from $1,800 an ounce down to $1,300 an ounce within 12 months. But they were buying all along, so their cost was significantly higher than the market value at the valuation date. So inventory valuation methodology is very important. And, of course, opposing counsel during cross-examination, why wasn't this historical cost? They did it at historical cost. So what? You know, for insolvency purposes, it's fair market value, or fair market value. And so I won't get into inventory, but it's a very complex area that you need to be aware of. Prepaid expenses are expenses that are paid in advance that we expect to be consumed within the operating cycle. This would be such things. Typically, we see it as where you're paying rent in advance or insurance in advance, insurance premiums in advance, and so forth. The next next category is fixed assets, and I think everybody is pretty much aware of fixed assets as plant, property, and equipment. Property and equipment gets depreciated. The concept of depreciation is basically an accounting methodology to allocate the cost of an asset over the estimated period to be benefited. If I buy an asset, a piece of equipment, I expect it to last for 10 years. My depreciation charge will be over that 10-year period. How you calculate that depreciation charge is an accounting method. There are many, many methods to calculate depreciation. There's no one method. So again, as with inventory and your knowledge of how you develop costs, within the category of fixed assets, it's important to know how you're calculating depreciation. It can be a very significant item, as well as useful life. Now, some financial statements that I've seen will use, if you recall, the tax law makes it easy for a company to expense or charges an expense. I think it's up to the first $500,000 of assets acquired in a year. Some CPA firms, rather than doing something different for generally accepted accounting principles, will just move that over into the financial statements and show depreciation as being tax depreciation as opposed to generally accepted accounting principles depreciation. So there are generally some differences there, and we'll talk about those in a minute in deferred taxes. Next slide. Other asset categories are long-term investments. These are investments that are expected to be held for many years. There could be things such as securities, fixed assets that are not used in the operation, for example, surplus land. The land next to the plant that's not being used, that would be a long-term asset. Long-term investment, rather. Special funds like sinking funds and so forth would be long-term assets. And subsidiaries or affiliated company investments would be considered long-term assets. And there's other asset categories, and this is the next slide, please. We have other asset categories, which would be you'll find on some financial statements, but not many. Long-term prepaid expenses and long-term receivables are those items which are expected to go beyond the current operating cycle. Maybe 2 or 3 years prepaid rent in advance. Why you do that, I don't know, but some people do it. Next slide. Now we're going to talk about the liabilities, and from an accounting standpoint, a liability is defined as an obligation of the entity arising from past transactions or events, the settlement of which may result in the transfer or use of assets or provision of services, providing services. So that's the basic concept of a liability for accounting purposes. We have a couple of different categories of liabilities. Next slide, please. We have current liabilities, and these are the liabilities that are reasonably expected to be liquidated within a year or the next operating cycle. So the current liabilities are the liabilities that we expect to be liquidated by our current assets during the same accounting period, whether that's a year or beyond a year. These are typically accounts payable, unearned revenues such as unearned subscription revenue, portions of long-term debt that will be matured or paid off during the 12 years and so forth, during the 12 months, excuse me. We have another category called long-term liabilities, and these are reasonably expected to be liquidated beyond a year. Typically, these are mortgages, long-term bonds, and so forth. Next slide, please. We have some liability terminology which may or may not be familiar to many of you. We will commonly see something called an accrued liability. An accrued liability is a liability that exists, but the amount of the liability is an estimate. So we have the fact of the liability, but the amount is, shall we say, reasonably certain. It's not 100% certain, but it's reasonably certain. This would be like if your year ends on a Wednesday, it might be the accrued wages for Monday, Tuesday, and Wednesday. You know, those kinds of things. They're liabilities that do exist, but they're estimates. Contingent liability. Contingent liability is a circumstance that's usually disclosed in a footnote rather than the balance sheet. The common situation is litigation. If the company is involved in litigation and you're doing a financial statement, let's say it's an audit or a compilation or a review or a compilation, there might be a footnote in there saying that the company is involved in litigation and the loss at this point in time is not determinable. But you do have disclosure of the fact that there is litigation or there's contingent liability. This could also be environmental protection liabilities. It could be any number of liabilities depending upon the industry you're in. If you can reasonably...
Excuse me for a moment.
Yes. Yes, I'm sorry.
I just want to remind all the attendees that we are dealing with some technical issues and we are trying to maintain the slides being in sync with the presenter. So just bear with us, please.
Okay.
You can continue with your presentation, Dermot.
Okay, we're at contingent liabilities. Is that the slide that's up?
Right now,
okay.
It is on liability terminology.
Okay, that's fine. Liability terminology is great. Sorry, my fault. Yeah, we have the contingent liability, which is generally disclosed in a footnote, and if we're able to estimate the liability, it is shown on the financial statement, and that's really very subjective as to whether or not that will occur. If there's litigation, I know we value litigation different ways for different types of situations. So contingent liabilities will typically be in the footnotes, and if you can reasonably estimate the obligation, it would be in a financial statement with numbers. The next one is deferred taxes. Deferred taxes are taxes which might currently be due, not currently due, which are not currently due but might be due in the future. You'll see in the income statements, so we'll talk about Thursday, where you'll see income taxes might be deferred and currently payable. The currently payable taxes are the one you got to cut a check for this year. Deferred taxes may or may not be due in the future, and it's usually as a result of different accounting methods for transactions such as depreciation or inventory valuation methodology and so forth. Usually will create deferred taxes. Next slide, please. Next one is stockholders' equity, also known as capital. That's the portion of the balance sheet that represents the capital received from the investors in exchange for stock, donated capital, and retained earnings. The stockholders' equity represents the equity stake currently held on the books by a firm's equity investors. It doesn't mean it's cash. I know there's a common misunderstanding among the general public. You look at retained earnings, they think it's all cash. It's not. It's just the residual, as we said earlier, the assets minus the liabilities. Next slide, please. Other terminology that we use to indicate stockholders' equity, indicate equity, are in different forms of organizations. In sole proprietorships, for example, equity is called proprietors' equity or proprietors' capital. In partnership organizations, we'll typically see partners' capital. But in all cases, equity is calculated the same way. It's owner's investment, whether that owner is a proprietor, shareholder, or partner, minus distributions, plus or minus net income or loss. Next slide, please. Most people on the call are probably familiar with retained earnings, but just in case we'll mention it. Over the life of the company has choices with each year's profits. They can either distribute those profits to the shareholders or the partners in the form of dividends or distributions, or they can retain those profits to help grow the business. So that any profits that are retained to help grow the business are called retained earnings. So retained earnings is a cumulative number of profits that have been retained in the business over the life of the business. Next slide, please. The next one, the final piece of equity that we're going to take a look at real briefly is treasury stock. Treasury stock is stock of the company that's been acquired by the company and does not retire those shares. And treasury stock is shown in the financial statements as a reduction of stockholders' equity. If the treasury stock is retired, then it simply goes away and retained earnings are reduced. It's as if the capital from the amounts from retained earnings went into the capital of the company. It's going to be a little bit tricky on this one. So, okay, let's go down to the next slide. We have a sample balance sheet, and just one thing, if you can note, you can see that cash went down from 03, which is all the way on the right-hand side, to 04, which is in the middle, to 05, which is on the left-hand side. Cash started at $12 million, went down to $5 million. And receivables did the exact opposite. It went from $4 million in 03 to $5.5 in 04, up to $10 million. You can see other current assets, and this is what we call a condensed balance sheet, where there's not a lot of detail in the asset section. Next slide, please. And this is the liability section of the balance sheet, pretty much standard, but you can see the common terms in their billings in excess of costs and earnings. Under current liabilities, left-hand side, that's something that's typical of a construction operation. We see the phrase in there, accrued expenses, which is something we talked about earlier. Now we drop down to the equity section. The last line item is called accumulated other comprehensive income. That's something that you will generally only see in audited financial statements or reviewed financial statements. What that is an adjustment to the earnings of the company to reflect increases and decreases in such things as marketable securities that have where the market value of the security decreased, for example. You'll see a negative accumulated other adjustment such as you have in 05. It's not officially recorded on the company's books, but it is recorded for financial statement reporting purposes. That's the concept behind accumulated other comprehensive income. Next slide, please. Sample cases, and this answers some of the questions that were answered earlier. This was a case I had about 6 months ago. Company A and Z were brother-sister firms. Both companies owned equally by the same shareholders. Company A purchased equipment from manufacturers and sold it to Company Z. Company Z was Company A's only customer. Company Z installed the equipment in leased premises and strip shopping centers. When completed, the locations were sold as a turnkey operation, and the purchaser assumed the lease. Company Z also serviced the equipment. Company Z filed for bankruptcy, and Company A purchased the property and equipment, the computers, the desks, etc., for $80,000. Company A continued the operations of Company Z in the same location with the same workforce as Company Z. Next slide, please. A claim approximately $200,000 by a landlord of a strip center survived the bankruptcy. Landlord sued Company A since Company A did not pay reasonable equivalent value for the assets. Landlord argued Company A took intangible assets. For example, the URL. The Company Z's URL was still being used by Company A. workforce in place, processes, customer lists, and relationships, etc., without adequate consideration. So company A purchased the tangible assets for $80,000. The assertion by the plaintiff was that they took intangible assets that weren't on the books, because we said earlier intangible assets weren't on the books when the company does it and when the company creates them themselves. So Company A argued that they had acquired the assets at appraised value. They got an appraisal of the desks and computers, etc. The trial court found for the defendant, and the case is currently on appeal. We have a question. I think we're set for questions or whatever you want to do at this point.
We are now entering the Q&A session. During this time, please enter the passcode in the Q&A widget. The passcode is statements. Also, please enter any more questions you have for Dermot. Please remember that if you are applying for CLE credit, you must attend for the full 60 minutes of the presentation. You are also required to complete the survey at the end of the program. Our first question is, can a compilation be used to establish the fair market value of the company, or does it need to be an audit or the financial statement?
None of the things you just indicated can be used to establish the fair market value of the company. That actually came up in litigation last week, that a financial statement, whether it's a compilation or an audit or a review, is a starting point. Revenue Ruling 5960 is a foundational document in business valuation and requires that you consider the asset approach, the income approach, and the market approach. If all parties agree, of course, you can use anything you want, but it's not going to hold up. So the financial statements are a starting point.
Would the recipient of a financial report view the report negatively when the CPA expresses no opinion?
I missed the first couple of words, please.
Would the recipient of a financial report view the report negatively when the CPA expresses no opinion?
That depends on the recipient. If it's a bank, probably not, because most banks today will accept, for lack of a better word, just regular financial statements. So I don't think there's a view one way or the other. Lending communities seem to be less demanding for accounting reports when they're taking financial statements, and many times will just take what the client prints out of QuickBooks.
Where should I look to determine the level of assurance on the financial statements?
I'm sorry, I missed the first couple words.
Where should I look to determine the level of assurance on the financial statements?
Okay, thank you. The level of assurance on a financial statement will be the accountant's letter on top. Before the financial statements, you'll find an accountant's letter, and that will be an audit compilation, audit reviewer compilation, and that will express a level of assurance. So it would be on the accountant's letter.
If sole shareholder of a small company is gifting her shares to her daughter, would you need to value the business for a gift tax return? If so, is there a best method to value the business?
Okay, here's where we go. The IRS requires that the business be valued at fair market value. Fair market value evaluation for tax purposes gets involved with discounts for marketability and discounts for premiums, discounts for lack of control. The practical answer is that I think right now the exemption is $14,000 per year. The practical answer is that if you're in that area, we recommend that you can do what we call a calculation of value as opposed to a conclusion of value, which is an opinion of value, because the risk on a gift tax situation is relatively low unless you're talking about some really big dollars. I mean, I've done valuations where the value was 10, 15, 20 million on transfers, and yes, those really need a full business valuation. But something where you're close to it, I think as long as you have a letter in the file that say calculation of value, you should be okay. The other piece of it is gift tax requires that you have adequate disclosure, and if adequate disclosure is contained within the body of the gift tax return, then really evaluation isn't necessary. So the question is whether or not adequate disclosure is in the gift tax return. You can get out of that liability by just doing a regular business valuation.
Last question. What happens if treasury stock is canceled?
If treasury stock is canceled, it goes back into the shares available. You'll have the total capitalization of the company will not go up, but you'll have more shares available for issuance in the future, and the amount that was in treasury stock gets offset against retained earnings, so your retained earnings goes down by the amount of the treasury stock that was canceled.
Okay, thank you for answering those questions. In addition to being your best source for testifying and consulting experts for the past 60 years, TASA also offers e-discovery and forensic solutions, free interactive webinars, and day-in-the-life videos. We also offer research reports on expert witnesses, such as the Challenge History Report 2.0, Professional Sanction Search, and Expert Profile 360. Please remember that if you are applying for CLE credit, you must have attended for the full 60 minutes of the presentation. You are also required to complete the survey at the end of the program. I want to take this opportunity to thank everyone for attending, and most especially P. Dermot O'Neill for his time and effort in creating this presentation. If you would like to speak with Dermot, or if you would like to speak with a TASA representative regarding an expert witness for a case that you are working on, please contact TASA 1-800-523-2319. One of my colleagues will be following up with you regarding your feedback on today's presentation. This concludes our program for today.
I apologize for Comcast.